Yes, I want to talk about this is something you can find on Tasteworks. I'm going to be looking over here at my secondary monitor, so who cares? We apologize for the background noise because the server, blah, blah, blah. You've heard about my excuses before. So, uh, what we're going to look at is broken wing butterflies. Let's look at what I did yesterday, and we'll kind of set that up. As you can see over here, this is the initial trade for the broken wing butterfly. And this is in Southwest because there was a big fear yesterday of, oh my gosh, COVID, Delta variant, blah, blah, blah. So this is let's do this in another cycle. Let's do just like the 31-day cycle for the sake of argument. I mean, we may come back to that. So, butterflies. Here's one reason to like butterflies. It's a small credit. So as you can see down here, your probability of profit, this is to make 1 cent, and it's basically a maximum profit of $10 with a maximum loss of 90, which would be right there in the middle. But, with an 88% chance of making 10 bucks, what you can do is define your loss and your profit here, very easily for small accounts. And as you can see, buying power is 89 bucks. So that's basically $100, which is the width of these spreads. And apologies if I'm going kind of fast here, but some of this knowledge is probably kind of basic. So please ask questions. Please ask questions. We could go through this a little more, but there's tons of videos out there on basics. So this is the kind of trade that you can set up. If you want to limit your risk, if you want to take on a little more risk, you can do what I did. As you can see over here, what I did, instead of what would have been, like a 45, 46, 47 trade, we'll go ahead and put that. So let's call it 45, 46, 47, which is what that would have been. That's a $6 credit. I did what's called a broken wing butterfly, and the reason I did that is because I figured Southwest would be up again today or soon. I think the fear yesterday was a little bit irrational. I think the market was a little bit oversold. And Southwest doesn't make a whole lot of money off of international travel, which is where kind of United is losing their butt, I think. So anyway, that's how you would set this up as a normal butterfly. What we want to talk about or look at is what's called a broken wing butterfly. And that means for part of it, actually, how did we set this up? Okay, sorry. Let's invert this. Sorry. Yeah, sell 2, buy 1. Let's go back to that. So 45, 46, 47. Because that's what we did. We sold the 2 in the middle, and we bought the other 2. So we own these. So that's normal butterfly. You only make money in this range. Now when you do a broken, look what happens to the graph here. This means we make money if the stock goes up all the way in this range. Now normally these are set up with like a 30 delta. So let's sell the 230 deltas. We'll still do 1 wide here, and then you can kind of adjust what you want to adjust. You can go for more credit here, but look what happens to your maximum loss. And that's up to you what you want to do. So I did kind of a weenie one. So what, there's a 6-point spread, so it'd be something like 43. So it's something like this. 53-cent credit. That sounds about right because I got a 69-cent credit. So we can take a look at our analysis, and that shows, if you can get it to zoom in here, one big spike right there. Like that's where you want your options to expire as you go towards expiration. See that big spike right there? That's where you make the most money, when it expires right at the 2 puts that you sold. And over here, see, this kind of limits, we're still limited on loss. See, the curve flattens out here. Our max loss of $448. However, since we have the theory that Southwest is going to go up, and it did, it went up by $3 today, which is about 6%. It's a big jump from yesterday. That, if it ends up out here, fine. We're happy. We're going to make money all the way out, no matter where it goes. So that's kind of the theory here of a broken wing butterfly. Now, what I did today, let me close this tab here. Oh, come on. I always forget how to do that. Go away for now. And there's my chains on the side. So what I did today, good lord, I need to learn how to use this platform better. Ugh. There we go, I think. Okay, so now we're back. Alright, so what I did today, you can see the roll here. Like originally I had sold a put like this, like not asymmetrical, which is why it's called a broken wing butterfly. It's not a symmetrical put, which is why it can be routed for credit, which is why I got the $69 yesterday. Now today, since it was going up, what I did was I closed out that 40 put right there, and I bought back the 45. So, in this scenario, setting this up for the 31 day, what we could do is go back and, make that into this. See, it's an 8 dB. Like, that's a very small range. Now, what I've done with my particular one is I've made this where I'm going to make money no matter what. Like, no matter where this closes. Because, as you can see, I brought in 69 cents. I rolled this to a standard butterfly trading 32 cents back. So I'm up by 26 cents, and we can go over here and kind of see that. I'm up $37 here somehow. Anyway, I'm up 37 bucks. Now, so let's say if we look at analysis here, let's look at the curve. Okay, see, this is showing my other position that I actually have. If I'm lucky and it expires right at 46, I have a big spike, I have a big win. Now, this is the position that we're considering here, after we buy the put back, because as we all know, hopefully, as the stock price goes up, these lower puts become less and less valuable. And you can see this right here in the chain. See, these lower puts are less and less valuable. So as the stock moves this way, that 40 or whatever that we bought here is become less and less valuable. So we took part of the money that we made here with the 69 cents and we bought that out. We moved it up to where it's symmetrical. We could have just taken the money and run with it. So this is kind of your choice, whether you want to get your free butterfly out of this, your no-risk butterfly, or if you just want to take the profit. Personal choice. Sometimes I like to buy these little lottery tickets because there's nothing saying that Southwest couldn't drop back to the center of my spread, 46. Like right now, I'm in the 38-day cycle. So that's at the bottom of the expected move. That's the orange here. So, I mean, it's not looking likely like I'm gonna make money at this, but I could, because remember, as we stated, you start making money between this one and that one. You make the most right here, but if it does drop to 47, which is this strike, my potential for profit goes up to the maximum here. And 47, there is some range there. So it's not an unreasonable, gamble here to maybe just get that big payoff. So let's look at the analysis once again. These are kind of hard to decipher with two in there. Let's clear this out. Yeah, see, there's my profit potential curve. There's no scenario here where I don't make money. And there's the big maximum, so to speak. And honestly, I honestly don't know how it computes how it computes the 45. I'm not sure where that number is coming from. To me, if I do nothing, I've made $27. So I don't know what this comes from. Somebody in the comments tell me. I'm going to upload this to YouTube as well. You can look for RC Bullock on YouTube. And there's the bell. Market's closed. So I don't know. I'm going to make 27 bucks here regardless if I just let this expire. If I'm lucky, it'll come back somewhere in this range and I'll end up somewhere in this spike if we're lucky. So that's how you set up a broken wing butterfly. If you were going to set this up initially, like I said, I think I said it before. Let's do like a 59 day now, because it was 60, but now it's closed, so now it's 59. Typically, Tastyworks says to sell or buy these two, sell these two. The reason you sell 2 of these is so that you can pay for the others here. And the reason you can write it for credit is because you go, see, I want the cheaper one instead. I'm going to take more risk this way. So you're taking more risk here, but you're routing it for credit because you're thinking, well, it's going to go somewhere in here. I think this stock's going to go up. So $53, and then, you know, as the stock goes up, all these puts get cheaper and cheaper. You could buy it back and take the profit that way, or you could just buy back the one and move it. And this is not going to show that correctly because this hasn't had a chance to move yet and get cheaper as the stock goes here. Like, let's imagine 47.5. Let's say the stock jumped $2.50. See, that would be like 50 cents cheaper for that next stock. It's kind of that theory. So anyway, they like to sell the 30 delta, which is, you know, getting close to pretty far out of the money if you're not familiar with Tastyworks. This is one standard deviation here. You could do 2.5 wide spreads. That would be more. So as long as it's not symmetrical, as long as, you know, the wing is broken on one side, you can route these for credit. You know, this could be interesting because you're almost to the one standard deviation here. You can move it even further. Obviously, you're taking on more risk. If you watch these numbers down here, see, it shows your max loss increasing. Well, that's not too bad. Like just looking at that one, you have 75% chance of making any money at all, you know, 1 penny or whatever. And then you've got a max profit of 253, a max loss of 247, and it's only affecting your buying power by that much. So that's pretty good. It's like risk 1 to make 1. You're getting a small credit potentially right off the bat. You know, now naturally these are bid and ask prices. It could be anywhere from an 11-cent credit to a 7-cent debit. You know, you just don't know how it's going to be filled. You know, but you can say, you know, hey, net credit, good for the day. You know, limit me. If I don't fill for credit, I don't want it, or I'll do something else. And then so later on, you know, you let it go, and hopefully the stock goes up, and then you move it to a standard butterfly like we talked about. So I think that is about clear as mud. I'm going to drop my referral links and stuff in the video. I wanted to do that, you know, and kind of show it sort of real time, sort of real life, you know, what I did with mine. You can also drop here and see, you know, 69 cents, 32-cent credit. So fingers crossed, kind of. I mean, bad for Southwest, but good for me if their stock price drops down, because I'll make like $100 more. So I guess one last thing we could look at, yeah, so buying power 247, kind of just figuring if this trade went the same way, sort of. Let's see, maybe we can move all the strikes down, something like that. 20-cent credit, yeah, that's pretty reasonable. At max profit 230, max loss 230 with a 66% chance of profit. Would you go to Las Vegas all day long if you said, I have a 2/3 chance of making any money, and then I basically have a chance of doubling my money, so to speak, because there's your buying power. That's the most you're going to lose. So these are, like I said, once again, these are good for small accounts, you know, relatively low risk, and you're taking in $20 right up front. And as you can, you know, once again, there's no risk to the upside. And then if it moves up a little, you can take it back and buy your standard butterfly with it. So apologies, I forgot where I was going with this. What was I gonna do here? I think that was about it. Oh, I was gonna talk about return. So yeah, return on this is your buying power. Like I want to mention this really quickly. One reason I love options is it only takes like 20% of the buying power that you would for stocks, and you can have a similar risk profile for stocks. Not this type of trade, but other types of trade. You only need 20% buying power initially for options. Now, if the option goes against you, whatever, you might have to pump some cash into your account. That's a topic for another video. It's probably a good idea not to trade your whole account on options for that reason, because you might have to throw some money in it, if your buying power starts going down. So basically $230 quote unquote investment, whatever. So in 60 days, if this stock just kind of languishes out here, you've made $20 on a $230 investment. But your potential is obviously, like I said, to make $270. I don't know where these numbers come from. I gotta look at these numbers because it says profit loss expected $315, but it says max profit $270. So I don't know what that means. I gotta get smart on these profit and loss curves. I just don't use them, honestly, but I'd like to know exactly, okay, where'd that come from, because I'm seeing kind of different things to me. In other words, if your stock expires right at 50, which it could drop $1.43 in 60 days, sure, because it's right there already. So if that goes to 50, then I could make a lot of money, and I only invested $230. So one reason to love butterflies. Now, is it as likely that your stock you're going to pin that 50 automatically? No. But once again, you've got no risk to the upside, profit to the upside, and a maximum loss to the downside. And there's other things that you could do later, like you could dissect this and maybe close out some of it and then roll another put that you're short, something along those lines. Like, if it went below, you could close out your 2 puts and then roll these 2 or something like that. Which is another reason to love options, because you can always roll out in time for credit, usually. If your stock doesn't go too far in the money. Or you could roll it out for 7 months or whatever. I did that with United yesterday. I rolled it out a bunch and they came back a bunch, so I'll hopefully be closing that out soon. I just didn't want to get exercised, so I rolled it out really far, so less likely to get exercised when that option is far in the future, because the person who bought that had to pay extra premium for the time value. And I'll leave you with the thought of the day, which is we don't sell or buy stocks or options. We basically trade in theta, which is time value. We trade duration. We don't trade options per se. Now, this particular option, I actually traded fear a little bit. So I was like, I think this fear is kind of overplayed, and evidently the market agreed with me today because it bounced back 6%. So, and again, with this type of trade, my risk was low, and now my risk is nothing. And if I get lucky, I get lucky. So, anyway, smash the like, smash the subscribe. If you're thinking about getting a Tastyworks account, their fees are very reasonable, and their platform is great. So I highly recommend it. Not only that, if you deposit $2,000, then you'll get 100 free stocks or 100 free options, or I think there's some crypto. Basically, you get to choose, which free money you want. If you don't have 2,000, I would still recommend getting the platform, and you could have what's called a cash settled account, which basically means, you have to have the cash in there. You have to have $1,000, which, as we've seen, you can do stuff like this. You can take these small nibbles, with defined risk, with your $1,000 account, and then once you get to 2,000, then you can go on margin. Margin's nice because you could borrow against it for some cash if you had stocks held there, which there may be other better places to do pure stock. I have some stock, but mostly I just use this account for options. So anyway, If you'd like to see a video on something, and I realize I've gotten to the end of this video like 4 times as, as I ramble on. If you'd like to see a video on something else, let me know. Thanks for watching. We'll end it here, because I've teased you 3 or 4 times already with the end, and this is the end. See ya.